Welcome to the buying versus selling video. In this lesson, we're going to talk about the main thing you want to understand when you're trading, and that is the differentiation between buying and selling. So let me break it down in the sense of retail. Retailers like to sell things when the price is high and buy things when the prices are low. This is because as things change in value, they're standing to make a profit. The same thing is applicable in the foreign exchange market, where we are buying and selling currencies and making a profit off of the exchange rates. If you've ever watched Bloomberg and you've heard the terms bears and bulls, this is how we refer to different type of players in the market. The bulls are the buyers and the bears are the sellers. The whole goal is to understand when to buy and when to sell. And when I say sell, I'm not referring to a tangible item. When you are selling in any financial market, it is when the value of an asset is dropping. So when the value of a currency drops, you have to decrease in demand, and you want to place a sell because you are expecting the value of whatever it is that you are trading to go down. This is where we reference a short. Sellers cause the exchange rates to fall as the demand decreases for currency. If a trader says, I'm going short on euro versus US dollar, they're saying the euro is going to drop and the US dollar will be greater. So they are selling that euro against the US dollar. Typically, whenever you're buying or selling something, you're going to be doing it with the base price. So if you remember me talking about in the previous section, the base versus the quote, the base is always referred to as the currency in the front. It is the base for whatever you are trying to buy or sell. The right side of that currency is called the quote. Therefore, you're always exchanging. So just like a trader goes short when they're selling, they are also buying. And when they go buy, they are going long. So when you are buying, that means that the value of a currency is going to rise. When you have buyers in the market, buyers are bidding up prices. Buyers cause the exchange rates to rise as the demand for currency increases. So when you're buying at the lows and selling at the highs. Essentially, if the market is high and we're looking to sell, and when we sell at that high and price drops, that's how we make our money. Furthermore, we buy low. So if price rises, the value has increased, which means we have gained a profit. So you should know and understand the premise of buying and selling, which is essential for understanding any way of how you're going to place a trade in the Forex market. This concludes our training for buying and selling, and I hope to see you guys in the next video. Okay, so in this lesson, we'll be discussing what is a pip. It's extremely crucial, so definitely take notes. In addition to pips, we're going to be going over units of measurements as well as base versus quotes. A pip is a unit of measurement that expresses the change in value between two currencies. It stands for percentage and point. Therefore, if a currency exchange rate is going up or the currency exchange rate is going down, there has to be a unit of measurement to measure this movement. So every time currency moves up a pip or down a pip, this is how traders either makes their profit or lose money. So anytime we analyze price is broken down into three parts. The base currency is the number before the decimal and two numbers after the decimal. This is the base currency for the exchange for the country that is getting traded. Therefore, if we're trading GBP USD, that means the Great British Pound is 1.38908. That is $1.38 to the Great British Pound. The third and fourth decimal are the calculations of the pip count that is moving, either rising or falling. So if you enter GBP USD at 1.38908 and you exit at 1.39083, how many pips did you increase? This is an 18 pip increase. So I'm going to equate these numbers to help you understand money and how you make money from this. We already talked about a pip being a unit of measurement. So a lot of you guys know that I used to be in fitness, and I'm going to relate it to that. So if somebody said, Jessica, how far did you run today? And I said 3 miles. Basically, I just gave them the unit of measurement in the distance that I just ran. It is the exact same thing when counting pips. If I trade $1 per pip and you trade $5 per pip and the market shoots up 100 pips, I now have $100 and you now have $500. I hope this helped you guys to understand the graphs of how this works, because it's imperative in our next lesson as we're getting into leverage and lot sizes. See you soon. So now that we know what pips are, we can get into leverage and lot sizes, which is the topic of this video. But we're also going to cover the correlation of pips as it relates to lot sizes and how lot sizes are counted. So by now, you should understand how to make money, how we capitalize on the difference in these exchange rates and these exchange rates in the form of pips. So pips are counted in the fourth place after the decimal. If you're trading gold or the Japanese yen or an exchange rate of that sort, it will be 2 places after the decimal. So before we go too in depth, I want you guys to understand the 3 of the main position sizes used in the market to understand the micro, mini, and lot. So whenever a trader is trading a micro lot, they will use a 0.01 position, which will basically be 10 cents per pip. When a trader trades a mini lot, they are trading $1 per pip, which is 0.10 lot size. And lastly, a 1.00 lot size is a standard. This is equivalent to $10 a pip. Therefore, if the market moves up 20 pips and your position size is a 1.00, you've now gained $200 in your account. So for example, let's say we're buying the euro versus the Japanese yen at 130.80 and we cash out at 130.589. There's a 22 pip difference because remember with the yen, we count 2 numbers after the decimal place. Therefore, if your trade was accurate and the market pushed up 22 pips, you just made $220. However, it's very important to understand that just as easily as money can be made, it also can be lost, which is why education is key. Okay, so now that you guys understand lot sizes, it's very important that we go over leverage. The foreign exchange market is such a unique market because when the foreign exchange market first began, you cannot come to the table and actually invest in this market without having a minimum of $100,000. We haven't talked too much about brokers yet, and we'll talk more in depth about that in the next session. But essentially, when you first start trading, you'll sign up for a brokerage account. The broker makes it possible to use capital that is leveraged so that you can receive the most amount of returns possible for your given trade. So let's say we take the Webster's definition of leverage. Leverage is the ability to use borrowed capital for an investment, expecting to make profits and expecting for those profits to be greater than the interest payable. So nothing more, nothing less. When you fund your account, you are putting a deposit that is the down payment to your brokerage. And in return, your brokerage will give you a leverage that can be a ratio of 1 to 100 all the way up to 1 to 500. So essentially, for every dollar in your brokerage account, you will now be able to use either $100 or all the way up to $500 of their money, depending on which leverage you choose. Leverage and lot sizes are an extremely important part of understanding how to place your trades. So keep that in mind and what you've just learned, because as we go into our next session is very important while you're understanding spread. Okay, so now in this video, let's talk about the spread. In this video, you will gain an understanding of how the spread works in correlation to buying and selling and the broker's profit. So essentially, the spread is the difference between a Forex broker's sell rate and buy rate when exchanging or trading currencies. Spreads can be narrower or wider depending on the currency involved and the time of day a trade is initiated, as well as economic conditions. So the bid is the sell rate and the ask is the buy rate. The buyer is bidding for a price and they are buying on the ask. The seller is selling on the bid. So when understanding this, it's extremely important to make sure you understand supply and demand and how they are understood thoroughly, because if demand is high, there will be a low supply. That low supply will cause price to either have an increase due to a shortage, and if that price increases, it is going to affect the bid in the ask price. Alternatively, if supply is high and demand is low, there will be a surplus, which means price will decrease, affecting the sellers. Essentially, how much it will cost to buy or sell this currency, and when you subtract the bid from the ask price, the differentiating cost is what you're going to give your broker. What you give your broker is what we call the spread. Now, in regards to the spread and the spread having the ability to change, this varies based off of the time of day. Remember, we talked about trading sessions. So if you're trading outside of your session, spreads will be higher because there is going to be a difficulty for your broker to find a buyer to match a seller and a seller to match a buyer during that time frame. Therefore, they are going to charge you a higher price. The result of this high price is a wide spread, and this will hurt your profitability. The currencies involved can also affect the spread because if you're trading a pair that is an exotic or a pair that isn't popular, it will be harder for your broker to broker the deal. So let's say we take a market price of 1.20885 and we look at the price 1.20585. 1.20885 minus 1.20585 is a spread of 0.30, which will go to your brokerage, and that's the price that you have to pay to get into the market for a buy, and how much you have to pay to get out of the market if you go in for a sell. More or less, it's the broker's commission. So if you have a 3-pip spread and the commission is $10 per pip, you're paying $30 to get in or out of that trade, regardless if you win or lose. So that's it for this module, guys. This is the fundamental section of the entire premise of this course. So make sure you go over spreads, leverage, lot sizes, and everything else that we've learned during this module. And I'll see you guys soon.